All right. I want to thank everybody for joining us for today's session, the ABCs of REIT investing. My name is Kevin Miller, and I'm joined by Matthew Frankel, our lead analyst. And we're going to be spending the next 30 minutes talking to you about REITs and the different types of REITs. So we can go to the next slide, Matt, and we'll get introduced and we'll get things kicked off. Before I turn it over to Matt, if you're not familiar with who Millionacres is, if you haven't attended any of our live sessions yet, I'd like to take a moment and introduce who we are. We're an investment subscription service that's dedicated exclusively to real estate investing and different types of real estate investing. We are part of the Motley Fool family of companies and services, and we have three core offerings that we provide to our customers. They're real estate winners, real estate trailblazers, and real estate mogul. The solutions will vary from real estate stock recommendations to private placement commercial real estate deals. And the content that we offer as well, premium content, includes analysis, reports, and best practices that are really meant to satisfy the needs of novice and expert real estate investors alike. At the end of the day, our purpose is to make the world smarter, happier, and richer, and give outstanding business and investing advice at scale. So with that, let me take a moment and introduce our speaker for today, Matt. Matt Frankel is a REIT analyst, and he is a certified financial planner. He brings quite a bit of experience to the Fool. He's been contributing since 2012. He's a graduate of the University of South Carolina and Nova Southeastern University. And after he spent a few years as a high school mathematics teacher, he decided to combine his love for teaching, writing, and investing to help people manage their financial lives better. We're thrilled to have him. And I'm sure if you've been on any of these sessions, you're thrilled to hear Matt talk about some of his topics. And Matt, I'll turn it over to you and I'll come back on at the end.
So, hi, thank you, Kevin, for that nice introduction. And before we get started, I just wanted to take a second. Such are the times. I have my kindergarten daughter home doing virtual school. So if I do need to pause for a second, I will let you know, but just be aware that could happen. And another thing I wanted to say before we get started, I see some questions already popping up in the chat and Q&A features. I will get to some of those as time allows. I have a bunch of an overview of all the different types of REITs there are and some examples of each one, and just a few things to know about each one to go through. So a lot of material, but I will try to get to some questions as time allowed. And as Kevin said, we'll keep track of all the questions, even if I don't get to them today, so I can answer in a future webinar. Maybe we'll end up doing a Q&A webinar if there's enough interest in that. So just getting started here. There are two main types of REITs, although there are three bullets on this slide. There are only two main types of REITs. Equity REITs are the real estate investment trusts that people normally think of when they're saying the term. These are real estate companies that own properties and related investments and make most of their money from rental income on actual properties. Then there are mortgage REITs that own things like mortgages, mortgage-backed securities, MSRs, which stands for mortgage servicing rights. There's a lot of companies that just focus on the servicing side of the mortgage business. Meaning the company you pay your mortgage to, who you pay your mortgage to. A lot of those are mortgage REITs. So these are such a unique type of investment that they're not even part of the real estate sector. They have more in common with banks than they do with equity REITs. So generally, when I say the word REIT or the term REIT, I'm referring to equity REITs. If I mean mortgage REITs, I will specify. Big differences in investment dynamics. Mortgage REITs are meant for income, not for long-term growth. Mortgage REITs have dramatically underperformed the market over time in terms of price, just because they are strictly focused on dividends, not focused on things like growing property values and things like that. Equity REITs are more of a total return investment. They pay above average dividends, but also have growth from things like the value of their properties increasing over time, developing new properties from the ground up, improving their properties over time, recycling capital, which means selling non-core properties and buying higher opportunity properties. There's a lot of ways they can increase shareholder value over time. So that's really why I'm interested in REITs, is because of the equity REIT aspect of it. There are a few what they call hybrid REITs that are a combination of the two. Those are not very common, and I don't know any hybrid REITs that I am a big fan of. So for the most part, we are going to be talking about equity REITs. So there's no requirement for an equity REIT to specialize in a single type of property. There are some that buy a bunch of them, but most try to be really good at owning and operating a single type of commercial property. It's really rare to find a company that owns, say, office buildings and malls. And the reason is because owning and operating commercial real estate is tough. And you want to hire experts in specific types of commercial properties. For example, healthcare REITs will have actual physicians on their boards and things like that to really give them an advantage. So REITs generally specialize in a single type of property to really leverage the expertise of their boards of directors and leadership teams. So in the next few slides, we're going to go through all of the official REIT subsectors. The National Association of Real Estate Investment Trusts, they have a bunch of individual REIT subsectors that are very specific in their scope. So let's go through this quickly. So the first two, office REITs, pretty self-explanatory there. They own office real estate and lease to tenants. A couple of examples are Boston Properties, ticker symbol BXP, which is, I believe, the largest office REIT in the market. Empire State Realty Trust, one of my personal favorites. Ticker symbol is ESRT. This is the company that owns the Empire State Building. Most office REITs have some component of retail with them. They have a lot of, if you've ever been to an inner city office property, the first floor is almost always retail in nature. That doesn't necessarily make them a diversified REIT. They are generally considered office REITs, even if they still have a small component of retail, but that is still part of most of these. Industrial REITs, these are things like warehouses, distribution centers, factories. Prologis is by far the biggest one. Ticker symbol is PLD. East Group Properties, EGP, is another example. These are, if you ever see one of those giant Amazon warehouses, those are examples of properties that are generally owned by industrial REITs. This is a big growth area right now in the market because of the growth of e-commerce. Statistic Prologis loves to quote is that the e-commerce fulfillment requires 3 times the square footage of brick and mortar retail. So as e-commerce grows in size over the years, it is creating a big need for industrial REITs, which is one of the reasons Prologis has grown to not only be the biggest industrial REIT, but one of the biggest REITs of any kind in the market. Retail REITs, it sounds very self-explanatory, but it's very broad in scope, and most subspecialize. Like a mall REIT generally only owns malls. A REIT that owns shopping centers generally only owns shopping centers. And freestanding retail REITs generally only own freestanding properties. Very specialized type of real estate. The examples there, Simon Property Group, they own malls. Kimco Realty is one of the biggest shopping center players. And Realty Income, the first REIT I ever bought, is a freestanding retail REIT. These are 3 very different types of retail REITs, and they have very different types of performance history. As e-commerce has gained in size, I mentioned industrial REITs have really benefited. Malls and shopping centers have not. A lot of their tenants have gone bankrupt. A lot are closing stores, things like that. So mall REITs and shopping center REITs have underperformed the market over the past 20 years or so. Freestanding retail REITs generally have tenants that are not really susceptible to e-commerce headwinds. I mentioned Realty Income there. Their top tenants are dollar stores and drugstores, things that e-commerce really doesn't disrupt. Convenience stores, warehouse clubs like Costco and BJ's Wholesale are big Realty Income tenants. The freestanding retail REITs have actually outperformed the market over time, just because in the past, say, 20 years, we've had 2 major disruptions, the COVID pandemic and the financial crisis of 2008, in addition to the growth of e-commerce. But they've largely been insulated from all of that, and it's really shown in their performance. Realty Income has been one of the best long-term performing REITs in the market, so very different than the malls and stuff like that. So just because, and I'm spending time on retail because just because you see one of these subsectors doesn't mean that all stocks in that subsector are equal. A lot have subsectors like you see in the retail space. Next is hospitality REITs. This can also be referred to as hotel and lodging REITs. This includes owners and operators of hotels and resorts. These are really unique types of commercial real estate because of their lease structure. If you think of everything else we mentioned so far, office tenants tend to sign 5 to 10-year leases and make monthly rent payments. Industrial tenants tend to sign even longer leases. Retail tenants can sign leases of a decade or more. Hospitality REITs, they're leasing their properties to people staying at the hotel. So they actually lease their properties on a daily basis. A great business dynamic to have in good economic times, a bad business dynamic to have when things are going poorly. This is why if you look at a chart of any hotel REIT during 2020, when the pandemic hit, they got crushed more than most other types of REITs because they weren't making any money. Whereas even retail REITs, most of their tenants were still paying rent because they are on long-term leases. So unique lease structure is something to really keep in mind as you look at some of these hotel REITs. Host Hotels and Resorts, HST, is the biggest one in the market. Apple Hospitality REIT, they specialize in smaller hotels. They call them select service. Think of hotels that don't have like big restaurants and convention space. Extended stay hotels are a big part of their portfolio. So a bunch of different subtypes of hotels. Some specialize in big resorts. Some specialize in smaller properties. Some specialize in business travel. Another subsector of REITs that has a few other subsectors. A couple more residential REITs, self-explanatory. Most focus on apartment buildings. There are a few single-family REITs, but most are apartment in nature. The big differentiator between apartment REITs is where they focus. Look at those two examples. Avalon Bay Communities, ticker symbol AVB, is focused on urban and kind of high-cost areas. They have a big presence in the DC market. They're actually based in the DC market. They have a big presence in the New York market, San Francisco. Whereas Mid-America Apartments, MAA, they specialize in the Sunbelt states, kind of lower cost areas, more affordable. Just not that one's necessarily better than the other, just two different types of focuses for these residential REITs. And then you'll have some specialized residential REITs, like I'll give you another one, American Campus Communities. Ticker symbol for that one is ACC. They build apartment complexes, but specifically designed for college students to live in. Timberland REITs, an area that is not really in my wheelhouse. I don't own any Timberland REITs, but these are REITs that just own a bunch of land and they harvest and sell the trees that grow on their land. Weyerhaeuser is one of the big ones. They sell their lumber. They sometimes make products out of it. If you get a number 2 pencil for anything, a lot of times it has the name of a Timberland REIT on the side of it, whichever if one of the companies made it themselves. Healthcare REITs, another one with a lot of subsectors in it. Healthcare in general is a big growth market right now. The baby boomer generation, the biggest generation in the United States, is aging rapidly. The older segments of the population, specifically the 75 and older and 85 and older age groups, are expected to multiply in size over the next few decades, creating a big need for healthcare, especially in senior housing, medical offices. A lot more procedures as time goes on are being performed outpatient rather than in the hospital. And life science innovation in pharmaceuticals and medical devices has never been as exciting as it is right now. I mean, not even talking about the COVID pandemic, a lot of biotech innovation going on. So that's a big growth market. Many specialize in one type of those properties, but some of the, especially all the bigger healthcare REITs, own some sort of combination. The examples listed there: Welltower, ticker symbol WELL. They are the biggest healthcare REIT. They specialize in senior type properties, senior housing, skilled nursing facilities, things like that, but also have some of the other types I just mentioned. Physicians Realty Trust, ticker symbol DOC. They are purely a medical office REIT. That's one that specializes in a single type of property. And you could find, if you want to invest in life science properties, there are REITs that have that as either part of their strategy or as their whole strategy. So there's a lot of healthcare REITs, and most have a unique type of combination of properties. Self-storage REITs. Fun fact, over the past 27 years that NAREIT has kept track of returns, self-storage has been the best performing category of REITs by a wide margin. Public storage, the one that's listed there, everyone knows public storage. Most people listening probably live near one of those big orange storage facilities, one of the biggest REITs in the market, and has been one of the best performing REITs in the market, or best performing stocks of any kind in the market over the past, say, 40 years or so. Big success story there. These own and managed self-storage facilities, there's only a handful of them, and there's still a lot of room to grow because this is a very fragmented market. Most storage facilities are owned by single tenant or single property operators. They call them mom and pops properties. Most self-storage places are still kind of independently owned and operated. So A lot of room for these companies to grow still. A few more up and comers than public storage, but that's the big one. Infrastructure REITs, the two biggest REITs in the market are infrastructure REITs, American Tower and Crown Castle, that are listed there. You might not think of things like cell towers and fiber optic networks as commercial real estate, but they're considered real estate. Anything can be considered real estate if you own it and lease parts of it to tenants. So these companies own the cell towers. They lease space on their cell towers to companies like AT&T, Verizon, et cetera, and collect rent. So those are the two biggest REITs in the market. A lot of people love them as plays on 5G technology, myself included. The biggest difference between the two that I've listed there, American Tower, despite the name American, is truly a worldwide company, whereas Crown Castle is mostly focused on the US market. So that's the biggest difference between those two. Both huge, huge companies, though. Odds are you live near a cell tower operated by one of the two of those. Data center REITs, a relatively new category. Over the past, say, 20 years, the volume of data flowing around the world has exponentially grown. Think about how many internet-connected devices are in your house now compared to how many there were, say, even 10 years ago. The sophistication of data is getting more and more as time goes on, as we upgrade from 2G to 3G to 4G and now to 5G technology. So the need to safely store and operate networking equipment has grown with it. And that has created great opportunities in data center REITs. Digital Realty Trust is one of the big ones. Equinix is also a big one. Ticker symbol for that one is EQIX. And there are a few smaller kind of up and comers in the space as well. All right, so last two, and these are kind of the most loosely defined categories. And these actually mean two different things. Diversified REITs are REITs that own more than one category of property. So if a company owns, say, retail and office properties, it would be a diversified REIT. WP Carey is a fun one to look at if you want to investigate a type of diversified REIT. Specialty REITs refer to any kind of REITs that don't fit into one of those subsectors I've already mentioned. I listed a few examples here because there are a lot of them. Farmland Partners, they own farmland properties. EPR Properties owns entertainment-related properties like movie theaters and water parks and ski resorts and things like that. Iron Mountain is similar in nature to a self-storage REIT, but they own document storage facilities. If your doctor's office is required to keep paper records for 20 years, they might store them in an Iron Mountain facility. Outfront Media owns billboards and outdoor advertising. If you've ever taken the subway in New York and you see all those ads in the subway, a lot of those are Outfront Media ads, and that's considered real estate because they own those and lease it out to tenants. So they get to benefit from the REIT structure as well. So before I turn it over to Kevin for the last slide, let me hit a few of these questions real quick. I went through that quicker than I had planned to just because I saw a lot of questions coming in. Sharon says, what is the difference between a REIT mutual fund and ETF? All are bundled securities sold in one security. That's absolutely true. I often compare REITs to, say, an ETF for real estate in the sense that it's a bunch of investors pooling their money to buy a portfolio of properties. The biggest difference between buying a REIT and an ETF to diversify your portfolio is REITs have an advantageous tax structure. Because they are considered pass-through vehicles, REITs don't pay any corporate taxes on their profits, unlike most of the stocks that your ETFs probably own. So they have an advantageous tax structure. They qualify for the new pass-through tax deduction, same as if you own a small business. So just the tax structure, as I say, the biggest difference. And they're owning, other than that, they're owning properties, not stocks. Victor says American Tower is an interesting one, especially with 5G now. I see a comment that says Matt is awesome. I'm not going to address that one, but thank you for that anyway. Victor says also, I would love a comparison between REIT investing and buying a second house to fix up, rent out, and sell. Pros, cons, average yearly net profit, risks, and mortgage options. Let me unpack that a little bit because this is one of the most common questions I get when people want to start investing in real estate. Should I do REITs or investment properties? And I do both, so I'm pretty good to speak about this. So the big questions you have to ask yourself are, one, how much time do you want to spend on your investments? We do some research in REITs. You have a lot to learn before you can invest in your first one, which is probably why you're here right now. And you have to research your individual stocks or pay a service like Millionacres to do it for you. On the other hand, owning a house to rent out is much more time consuming, even if you hire a property manager. I can tell you firsthand, I spend more time on my rental properties than I do researching REITs to buy. I research REITs professionally to talk to people about more than I do either of those things. But in terms of managing my own investments, rental properties are by far the most time consuming. The other thing you have to think of is not just in terms of average yearly net profit. Rental properties have higher profit potential. If you're an experienced investor and you're doing it correctly, or you just get a really good deal or something like that, there's more profit potential in general from rental properties, but your profits will be much more inconsistent. Right now, one of my rental properties is a triplex, and a tenant that has been there for about 8 years just moved out, and I have to renovate that unit, and it's going to cost me about 6 months rent to completely do all the repairs I need to do to that unit. So it's not just, if you want consistent income and consistent growth, REITs are probably the better option. If you want to maximize your returns and don't really care about things being inconsistent, that's something you might want to look into rental properties for. So Bernardo says, a good question here, just with REITs, you don't get the tax benefits of depreciation as you would with a rental property. You do, but it's kind of passed through. The REITs you own absolutely take depreciation deductions every year. This is why earnings in other stocks, you'll hear earnings per share. This is why earnings per share is a really bad metric for REITs. It's because we know depreciation isn't an actual expense, but you get to report it on your taxes as one. So this makes REIT earnings look disproportionately low. If you look at a metric called funds from operations, or FFO, that adds their depreciation back in for the purpose of showing how much they're actually making. So REITs absolutely get the benefit of depreciation, but the REIT gets it, and it's reflected in the earnings that they're paying out to you. And the last one I want to hit before I let Kevin hit the last slide, Giannis says, which three are your favorites? I can't give you all my favorites because then we wouldn't. I tell them to our members in our service, but I will say, out of the 20 or so REITs that I've mentioned here, about 5 of them are active recommendations in Real Estate Winners. Kevin is going to talk about our Real Estate Winners service briefly, and we hope you will join us on this journey. And that's where you're going to find out our favorites, and not just our favorites, but the extensive research on why they're our favorites. So with that, I will turn it back over to Kevin for this last slide.
We appreciate that. Thank you, Matt. And thank you, everybody, for joining us again for our session today. We're trying to kind of keep our pace and run these on about a monthly basis. So obviously stay tuned for ones coming up in the fall. We want to absolutely hear your feedback on topics that you'd like to cover. We do have a couple of really cool webinars coming down the pike in September and October. So keep your eyes out, and you'll definitely get invitations for that. As Matt mentioned, we do an extensive amount of research into a variety of different investments in the real estate community, REITs being one of them. And the REITs are predominantly part of our Real Estate Winners package, which basically runs $250 a year. So you're looking at about $24 a month, $22 a month in that range is about the cost of it. If so, a few Starbucks, and you're getting a consistent package of highly analyzed REIT investments each month, and that's kind of your foot in the door subscription to the real estate world. And then there's different tiers of our Trailblazers, and then our Mogul, which gets very much into kind of private placement, commercial real estate deals. So it kind of goes, from one end of the spectrum on the REIT side up through commercial, private real estate deals. So it's a great way to get started. It's very cost effective. We are very much outperforming the S&P. This year, the Real Estate Winners, index, if you want to call it that, has been outpacing the S&P most of the year, and posting great returns. Which actually I think we even have a chart that we'll share with you on the performance of it in the follow-up email. So keep an eye out for that. There will be an offer. It'll have a discount associated with it. I think it's $29 off the $249 subscription. So you're getting a nice little chunk off of it. It brings it down to below $20 per month. And keep an eye out for that. Hopefully we'll get that to you today once we get the video processed and get that out to you. Hopefully, if you're not a member, you'll join, give it a try. We're also going to do, in this case, a 30-day money-back guarantee for it. So that will basically give you a full month to try the service out. If for some reason you don't like what's in there, you could basically walk away, and there won't be a commitment. So we don't do those 30 days that often, but we're pretty excited about how the performance has been tracking this year, and we'll be tracking through the rest of the year. So we're confident to offer that, because we think once you get in and once you try to service out, you're definitely going to want to stay. So with that, we'll go ahead and wrap the session up, and we will hope to talk to you soon. We will hope to be talking to you in other webinars. We'll hope to talk to you as members of Real Estate Winners. The session's now wrapped up. Have a great rest of your afternoon.